Hello and welcome to our presentation regarding how we manage someone's finances as a power of attorney. My name's Harry Greenbury and I'm from Hargreaves Lansdown. And the purpose of the presentation is to hopefully go through some information regarding key important questions that might relate to someone in that position and how they can help manage someone's affairs and finances. But then also specifically look at, through Hargreaves Lansdown, how you might be able to manage someone's assets through the platform that we offer. And what's contained in the presentation isn't meant to be construed as advice, so it is simply information. Hopefully then you can go away and make your own decisions from a bit more of an informed position. However, some of the issues that we might raise may be quite complex, and people may be keen to look further at paying for professional advice through someone at Hargreaves Lansdown as well. And we'll talk about how we can offer you that extra service if that's something that you wanted. Now, in terms of what we're going to discover and what we're going to cover today, first of all, we're going to have a look at taking responsibility. Basically, we're going to start off with kind of framing everything by looking at some of the impacts that might affect people who hit later life and therefore the people who are managing their finances for them. Some of the key questions we want people to think about. Then we're going to take a look at different sources of income in retirement. So predominantly focusing on those people who are maybe already receiving income, pension income and so on in retirement, and how those different forms of income might differ from each other. Then we're going to have a look at why we invest. So through Hargreaves Lansdown, predominantly used as an investment platform, why we might invest someone's money, how we might invest someone's money, and a few things to think about there. Then we're going to cover off whether or not we're investing for income versus growth, and then the differences between the two really. And then finally cover some tax implications. So if you've got different sources of income and assets built up with different providers and so on, how those different sources of income could be taxed and interact with one another. Now, first of all, just going to put some different statistics on the screen for you. I'm kind of here to highlight the significant impact that maybe caring for someone or helping managing someone's finances later on in life, the impacts that can have. And the impacts can be quite varied, including physical, psychological, and financial. So something to be aware of and maybe some important questions to consider really. First of all, top left, you can see 61% of carers surveyed here suffered physical ill health as a result of caring. Now, physical ailments aren't necessarily something you would immediately consider to be a real risk, but clearly that does have an impact, unfortunately. You can see the financial impact, where you see 30% of unpaid carers saw a drop in their household income of more than £20,000 when they started to care for someone. That's, of course, a really significant amount of money, something that could impact you greatly, your potential to save for the future yourself, but then also the effect on your lifestyle in the current and the present day as well. And then you can see sort of maybe the psychological impact that this kind of thing can have and these kind of decisions can have. On the right-hand side, we see 59% of couples, they leave long-term planning to just one of the individuals in the couple. So this can cause a bit of an issue because if something is going to happen or something unfortunate does happen to the person who is responsible and takes responsibility for those things and that long-term planning, and that can leave you with a lot of anxiety when left alone with things you don't necessarily understand. So it sort of highlights the importance of trying to discuss these things with important family members and relatives and so on, well in advance of hopefully things happening or going wrong. You can see then 44% say it would be difficult to take on the responsibility for long-term planning if that was to then become something that they needed to take care of. So that highlights really the anxieties that people might have of things going wrong and people ending up in positions where they feel a little bit out of their depth. Following on from that, we're just going to consider sort of 4 key questions. This isn't an exhaustive list. Of course, we've just picked out some key questions we would like power of attorneys, people who are in the position of managing maybe a loved one or a relative's money. Some key questions they might want to ask themselves before deciding whether or not they feel comfortable doing what they're doing, or whether or not they might need additional help. First of all, top left, how comfortable are you managing someone else's money? Because you may feel as an individual that you're very comfortable managing your own investments, your own pension, and so on. And you understand how much risk you're willing to expose yourself to. But does that same confidence apply when you're looking at someone else's money, a loved one's money, and the different stage in life that they find themselves, and the different way in which they might want to plan for the future as well? That's an important consideration to make, because if you're not that happy, that's when you might want to explore getting any kind of further assistance. Top right, can you support a parent if they were to run out of money? Okay, so this would be a really unfortunate situation, but if things are mismanaged, if they utilize assets unsustainably potentially, and they're left with sort of the bare minimum or whatever the state is prepared to give them in terms of benefits, are you able to support them in that position? That's an important thing. Again, we've already seen on the previous slide the financial impact that caring and so on can have on people. Bottom left, when is the right time to put an elderly relative into care? Of course, a very sensitive question to ask, a very difficult question to find the answers to. So are you confident in making that decision that it's going to be the right one? And then finally, how would you meet care costs and how would you manage the risks? So if you're trying to manage someone's assets, if you're trying to decide how you will be paying for certain liabilities, will it be through having a cash reserve and utilizing that cash to meet liabilities that arise? Will it be through investments and generating an income from investments to meet those liabilities? Will it be, for example, securing an income, which is then going to be guaranteed and then cover costs throughout the duration of someone's lifetime? Lots of different decisions for people to choose between. Are you confident that you can choose the one that you think is appropriate and the best? Or again, is this something that we might then need to maybe pay for professional advice beyond or some kind of recommendation in the area? Now, we said we're going to discuss different sources of income. And so following on from that, we're going to look at, first of all, secure forms of income people who are currently retired may well be receiving. When I say secure income, essentially more or less guaranteed income which is currently being paid potentially at the moment and will be payable ultimately until death. So on the left-hand side, we've got the state pension. So this has been built up through national insurance contributions throughout the individual's working life and is actually paid by the UK government until death. Now, the state pension has gone through various changes in its history, as you can imagine, and so the exact entitlement to what that state pension might be could vary, including when it comes to death benefits and whether or not any of that payment could be passed on to a spouse. Looking at finding this information online will give you a little bit more detail on what the specific situation is for the individual if you wanted to find out more. Second, we've got defined benefit pension. So this is again sort of a guaranteed income which has been accrued through your employer this time and will be payable until death. Now, essentially how this is calculated is based on your salary or income with your employer and the length of service that you spent working for them. And essentially you just get a percentage of your salary paid to you for the rest of your life on a decided or agreed upon retirement age. Again, payable until your death, and then ultimately there may well be some benefits to a spouse upon your death, and it may well be that a fixed percentage of what you were receiving as income is then going to continue to your spouse or to their spouse upon their death. Then finally, you've got a lifetime annuity, which is another source or form of income which is guaranteed, being paid on a regular basis until death. But the way you've sorted out an annuity is essentially you've purchased an income using your pension pot from an insurance company. They try and establish what your life expectancy ultimately will be, and then they will give you a guaranteed income then for the rest of your life. Now, what happens to a lifetime annuity upon your death is dependent on what you'd set up when you first entered into the contract and purchased that income, because there are lots of different factors that you can consider. There can be guarantee periods for that income. The income may increase each year with something like inflation, for example, and whether or not it'll be passed on to a spouse in terms of a regular income upon your death as well, or the annuitant's death, depends on what they decided upon at the start. Again, something that can be found out relatively easily ultimately. But these three just represent three common sources of what we'd say, more or less guaranteed income, which is going to be rolling in each year until the individual passes away. Secondly, we're going to look at more flexible sources of income. So what we've started with, first of all, is drawdown. Now, that's an option that you've got when it comes to accessing your pensions, and it gives you a bit more flexibility to keep control of the money that you've saved up into your pension. Now, ultimately, the drawdown and the investments ultimately work in a very similar way, but it gives you a flexible source of income. You can invest the money across a range of different investments within your drawdown account. The key thing when it comes to drawdown and these flexible sources of income in comparison to secure income is that the investment risk is on the individual themselves, because they essentially retain ownership of that money and of the assets and where they're invested. And so the income and the sustainability of that pot of money is really dependent on how it's invested and how the income is withdrawn over time. If it's not withdrawn in a very sustainable manner, then that might deplete the value and the size of that drawdown account. Now, when it comes to your drawdown investments, they're held outside of your estate for inheritance tax purposes. So that's an important point. Can be a very effective way to pass on money to future generations ultimately. So that's true of your pensions held separate from your estate. Move on to investments, which is very similar, except in this case, we're talking about investments that aren't held within a pensions wrapper. Again, flexible income can be determined by the individual and how much income they want to take, but that includes the investment risk, which is on the shoulders of the individual. Now, investments can be in many forms. It can be in shares and bonds and so on, typically the type of thing we see people investing through a pension. We're going to talk about those a little bit later on, but also it might be in things like property and rental income and so on. Also with investments, you may be making use of other tax shelters, like an ISA, for example, so that money you've saved and put away over the years is then going to be tax-free when paid to you. Ultimately, what's different from just general investments in comparison to drawdown is that they usually form part of your estate upon death. Now, in terms of finding out more, we've just done a quick list here of who you might be able to contact if you need more details about someone's situation, really. So the first three, in terms of the secure forms of income, to find out more about the state pension, you can contact gov.uk. Essentially, it's the government that's paying that income. You can find out information online through like the Department for Work and Pensions and so on. A defined benefit pension, you'll have the pension administrators. So hopefully an individual has received communication throughout their working life, and then also in retirement, informing you of what they're entitled to and the terms relating to a defined benefit pension. So they'd be the people to get in contact with. When it comes to an annuity, if you want to know details and confirmation of what was first agreed upon when you entered into the contract, then yeah, contact the annuity provider. Again, something that you should have various forms of communication with from when contracts were first signed and so on. The key point I tried to mention a moment ago is when it comes to these sources of income, we're talking about very low maintenance in terms of managing. There's no investments for you to have to worry about managing. You've already secured an income and it's already being paid to you, and there's nothing you can really change with that. That's just going to continue until your death. What involves a lot more higher maintenance for an individual when managing someone's money are the investments, whether that be in drawdown or just general investments you might have across other platforms. So if you want to find out more information about these, and then sort of how you can invest, where you can invest, the changes you can make to ensure the right decisions are being made, you'll have maybe a platform provider when it comes to drawdown. So someone who's holding that pension somewhere and having it invested. It may be something that's already done yourself, or maybe something that is done by an advisor, for example, Hargreaves Lansdown, where you have maybe an extra charge. And then investments as well. So you've got the platform provider, maybe an ISA provider if you've put it into a tax efficient savings vehicle. But again, also it might be something you pay additional fees for to receive advice. But as we said, generally these are higher maintenance because the investment risk is on the individual. And you can deplete the funds, you can run out of money. So that's the important point. A bit of a split between those two different sources of income, really. And in terms of maybe relating specifically to pensions, I just wanted to signpost PensionWise, which was brought in 2015 when the pension freedoms were announced. So it's just a free and impartial service which is provided by the government to people who are aged 50 and over and maybe want some further information when it comes to the various different pension options that are available, because they are, since 2015, a lot of freedom has been opened up to all individuals across the UK. Now, just moving on now, we're going to briefly look at how much cash someone might hold or maybe be considering to have in reserve when it comes to just managing their general finances, really. So the importance of holding cash and money that can be easily accessed and called upon in the short term is really important to make sure that if there's any unexpected or unfortunate circumstances arise, we have the security of money which is held in a very safe place, isn't at risk of fluctuating in value, and we can call upon to meet those needs. I suppose the importance of this type of thing has maybe really become apparent over the last few months when we consider the pandemic and the negative consequences that have come about because of that. So just as a general rule, what we'd say here, if you're currently employed, something to consider as a kind of emergency fund or cash reserve kind of buffer would be about 3 to 6 months, or between 3 to 6 months worth of expenditure, easily accessible, so you can call upon it if you need to. That then maybe increases when it comes to people who are retired. So then we increase that maybe to sort of 1 to 3 years worth of expenses to be available in cash. So a little bit of a difference there, but of course something important to bear in mind if we are managing someone's finances and their total assets. So it's another thing to point out, we'd usually say at HL, is if there are planned expenses or expenditure over the next 5 years, also something to be consider maybe holding that money back as cash rather than having it invested in things like the stock market, which of course can be very unpredictable over the short term. Now, how you might be able to do that through Hargreaves Lansdown, we have a relatively new service which is called Active Savings, which is a nice, easy way for people to try and hold cash deposits with a bank, but also try and get access to competitive interest rates. So you can have an online account through HL, and we have a panel of different banks, and you can then try and compare the different interest rates and maybe the different terms. So whether or not you want an easy access account, whether or not you want it fixed for 3 years or 5 years and so on. And then you can decide what you think is best. But one of the key things that makes this very easy and convenient for people is that You don't have to go to every single different bank individually and go through an application process. It's just one application through us, and then it's all nice and simple for you, all under one online login. So just an easy and simple way of trying to get access to competitive interest rates and make sure we're getting the most out of that money that we are maybe keeping as cash in reserve in the background. Now, what we're going to cover now is sort of through Hargreaves Lansdown, how you might invest, but also then why we might invest. So into what types of things people's assets could be currently invested when it comes to maybe their pensions and so on, and the differences in risk associated with those as well. So first of all, to get things started, we're going to look at how different assets have performed over the last 25 years. Now, this will give us a comparison in terms of if you're managing someone's assets, what types of risk they might be exposed to, and what types of maybe volatility you can expect from someone's investments if you are trying to make decisions about where to put them. First of all, we're going to start off with cash. So we've just briefly talked about that now, a very low risk way of investing your money. As you can see here, this shows the performance of a typical building society or bank account over the last 25 years. So as you said, very low risk because it's not going to fluctuate in value. It's not going to go up and down like the stock market does. And as long as the bank survives, you're going to be able to get access to that money. Indeed, it's covered by things like the Financial Services Compensation Scheme of up to £85,000 for a deposit. So that's where you are very well protected. Now, when it comes to that protection, it just means that because you're not taking much risk, the return isn't necessarily the most attractive, but it gives us that security. Now, the one thing or important risk we need to consider when it comes to holding large amounts of cash for a long period of time, especially when we stretch this out to 25 years, is that of inflation risk. This is the rising cost of goods and services, the rising cost of living ultimately over time. Now, the longer we stretch that out, you can see the more of an impact this has. And the value of that cash you've got saved is eroded year by year. So that's something, when we look to longer term investments, we want to try and avoid. We want to make sure that money we've put away or that money that has been saved is going to grow at a rate which at least hopefully exceeds inflation ultimately. And to try and achieve that, through the assets that we've got on the platform with Hargreaves Lansdown, they tend to really focus on two main types. First of all, we've got bonds. Now, specifically here, we've got gilts, which is UK government bonds. And that's where you loan money to the UK government, and in return, they give you a rate of interest on that loan. Now, you're taking a little bit more risk, of course, than just leaving your money as cash in the bank. Because if you loan your money to the government, or indeed a corporation, which is possible to do through corporate bonds, then there's a risk that they won't be able to meet those interest payments. And so you'd lose out. Also, bonds get traded on an exchange, and so the demand for a bond will influence the price as well. And you can see those fluctuations over the last 25 years. But ultimately, a return in excess of inflation is what we're after. So moving on from bonds, which tend to be lower risk, lower return investments in general, certainly in comparison to shares on the stock market. So this is the UK stock market over the last 25 years. As you can quite clearly see, a lot more volatility is apparent when we look at the long-term performance. You can see clearly the financial crisis about 12 years ago, and a big chunk of value was wiped off the value of the stock market. Of course, something that would be very alarming at the time. And then, of course, more recently, this year with the pandemic, and you can see the big drop-off in value that we've seen. Of course, as we said, that can be very alarming at the time. But one of the advantages and the attractions of investing money into shares and individual companies on the stock market is that historically, the long-term prospects for growth have been very good. And so you can see that over the long term, despite what are big fluctuations, you can see still quite a significant return on that money is available, which, as we see, has beaten inflation as well, something we're after. And of course, picking your own shares and picking your own bonds and so on is a very difficult job, ultimately, especially if we're not necessarily professional investors ourselves. And so that's where, through Hargreaves Lansdown, the research that we provide online regarding funds, that's what tends to be a very popular way of investing for people who want to get access to a little bit more expertise. Now, what we're going to describe now is essentially how a fund works. So this might be a recap for some people, it might be new information for others, but it's important, as you know, if you're managing investments through Hargreaves Lansdown, this is predominantly where our research is focused. So the way a fund works is essentially all investors' money in a particular fund, maybe everyone on this particular presentation or listening into this presentation, for example, all those cash contributions to that fund are pooled together, and then a fund manager is going to take that money and they're going to spread it across a range of different shares and bonds, broadly speaking. So they do this for a few reasons, really. First of all, by spreading that money across a range of different investments, you achieve diversification. Now, why that's attractive is, for example, if you put all your money and invest it into one individual company and that company goes bust, then you lose everything. But if you spread it across a range of different investments and a range of different shares, then you mitigate that risk to some degree. Also, you're getting expertise to getting access to expertise of a sort of a professional, which is maybe attractive to someone who wouldn't necessarily know how to invest it, and so maybe they're able to make the right decisions or better decisions when it comes to which shares and which bonds to pick. And then also, it's a very cost-effective way for people to get access to lots of different shares, because you don't, as the individual, have to pay different transaction fees on purchasing lots of different individual shares and bonds yourself. You just pay one ongoing charge to the fund manager on a rolling basis, basically. In terms of how they might invest that money, we've got an example here of how that could be allocated. So broadly speaking, it might focus on things like shares and bonds, referred to here. You can see the bonds as fixed interest investments. They may invest it or leave a little bit in cash. They may invest some in things like property. But ultimately, the way they allocate that money to those different assets is then going to influence how much risk you're exposed to as the investor, and how much volatility you're exposed to as the investor. If it's investing heavily in shares, that might be good for long-term growth prospects, but volatile along the way. If you're investing in bonds, you may not have the same long-term potential for high growth, but maybe a little bit more security over the shorter term as well. Now, through Hargreaves Lansdown, I just touched on, we then have various different resources designed at helping people choose how they might invest their money. Now, what we have here, and it's just going to run through a little video, is just an example of a fact sheet page which we have available for all the funds that we have on our website, and sort of looking at how you can compare how they've performed and so on over the last few years. So I'll just roll the video, and what you can see, there's information on charges, information on Hargreaves Lansdown research, information about where it's invested, information about what the objectives of the fund might be. What we've just looked at here is it's picking out a certain sector that this fund belongs to, and we're going to have a look then at the charts and performance, and then compare that performance to the average for that sector. So we can get an idea as to how an investment might have performed relative to some of its peers. What HL is trying to identify is some funds which we think will outperform the average funds in their sector, to try and give you as an investor a little bit of extra value. Now, we touched on, when it comes to a fund, the advantage of funds is that they diversify your money. Of course, we're not necessarily just talking about diversification on a UK or nationwide scale. We may be considering that on an international scale. So because of the range of investments that you have available, you can spread your money across funds which invest all over the globe. And ultimately, the advantage of that is, just like some individual companies will perform better than others, some stock markets from different areas of the globe will perform better or worse than others. And so diversifying across the globe gives us access to lots of different stock markets in the process, some of course which will perform better than others. Now what this is showing here is the portfolio analysis tool that you can look at through an online account at Hargreaves Lansdown. It gives you a breakdown of where your investments, so if you've got a range of different funds, how they are then actually spread up when we look individually at the shares and the bonds that they've chosen to invest in. So again, an important tool to use if you're looking at analysing the state of your investments as it stands at the moment. Again, moving on from this to try and help people achieve that diversification across different assets and also different stock markets, we've got a tool online called our Master Portfolios. So this is quite a popular tool and quite good at trying to identify different areas of investment. How it works, quite simple really. You look at maybe adventurous, medium or conservative approaches to risk. You then maybe have a lump sum that you want to invest. Maybe it's a monthly amount being paid into an account somewhere. And then it's going to give you and generate a suggestion of how you might split that money across various different options. So these are a selection of some of our investments which we believe have a good prospect for achieving growth that's hopefully in excess of the sector average, try and provide you with that extra return, represent as well very good value for money, and we think are managed by some of the best fund managers in the business as well. And you can see here, just as examples, what it's giving us a spread of is access to funds investing in different areas. The US, the UK, global funds, which will stretch into maybe places in Asia and so on. And you can also see here in the example, there's a mixture between bonds and investing into shares or companies as well. So ultimately, if you went for something more adventurous, it would focus, as we touched on shares around the globe. Conservative would focus more on bonds around the globe, and then somewhere in the middle, you might have a little bit of a mixture. So that's just an example there. You can then play around with these. Each individual fund here that you look at, you can take and then go onto their fact sheet page, the example of which we saw in two slides previous. Now, just before we draw things to a close, we're going to look at investing for growth versus income. So something to consider depending on the stage of life someone might be at and what they're ultimately trying to achieve from their investments. So start off with investing for growth. Now, ultimately, this might have a more long-term outlook, looking for growth potential and to grow assets to maybe then utilize them later down the line. Now we see the points here, low dividend yield and dividend reinvested. So a fund looking to do this, or companies that are sort of growth companies, may well be making profits, but rather than sharing it with their investors, they're trying to reinvest that back into the company to continue with innovation and growth of the company to make it bigger for the future. So again, we have that longer term outlook, and we're going to really reap the benefits because the value of that investment is hopefully going to grow and grow. Versus investing for income. Now, this might be particularly relevant for people who are currently in retirement, maybe, for example, whereby they've got investments, but they need to generate an income now from those investments. So that might be focusing on funds or then subsequently companies which have a higher dividend yield. Ultimately, companies that have consistently performed well and have shared profits with their investors. And so that provides an income for the individual investor. Now, ultimately, this is important because it may well supplement income needs in retirement. And something to mention when it comes to companies and funds paying income and paying dividends is that although the price and the value of shares may fluctuate quite greatly, like we've seen earlier on in the presentation, the desire to sort of maintain a more consistent dividend and distribution of profits to investors is really important to those companies. And so ultimately, you may well experience less volatility, typically with the consistency of a dividend. And ultimately at the bottom, I suppose another point here is there's still potential for growth. So the value of the companies that you invest in can still go up in value, but of course the primary focus is to make sure that that is providing an income to meet your needs. Just as a quick comparison, side by side, growth, looking at companies that could grow revenues over time. That might be by reinvesting profits that are made, but may apply to companies that currently have an edge over the market at the moment. So it's something they can take advantage to rapidly grow over time. Of course, when we think about smaller businesses who are looking to rapidly grow, that could lead you to experiencing increased volatility, because a smaller business may well have a greater potential for failure and so on. Then you've got income. Now, we talked in the previous slide about shares, providing company shares and dividends or company profits being distributed amongst investors. Other things that you can invest in for income would be bonds. So like we touched on, loaning money to the government, loaning money to a company, and in return, then paying you interest on that. And that is ultimately a form of income for you. But when it comes to the companies themselves, they may well be larger companies that have produced a consistent and strong dividend over time, and distributing that, of course, with investors. Now, we're just going to briefly touch on the tax treatment of different sources of income, just so people are clear with the various different ways you can receive it. So first of all, we touched on some different forms of pension income, whether it be from drawdown, whether it be from the state pension, whether it be from defined benefit pensions, whether it be from annuities. Now, ultimately, that income is taxed at your marginal rate. So you essentially just get taxed at income tax rates on that, and they'll add up. They'll be added to each other if you have various different sources of pension income during the course of a tax year. Now, with some pensions and accessing some pensions, you may well have got a tax-free cash lump sum at the start or when you started, first accessing your pension as well. So that ultimately may well have already been taken. There may still be some to take. There may be all of it to take if you haven't yet accessed your pensions. Now, general investment accounts here. There are some taxes to be aware of. If you invested across shares and bonds and so on, then ultimately there might be a dividend tax, capital gains tax to be aware of, or income tax. You do get allowances for each of those three potentially, but if you go over that with your income, then you may well pay tax. Having a bank account, if you've just got cash deposits and you're earning interest on that, anything above certain allowances, it does depend on your tax status, would then receive income tax as well. A very efficient way of generating income for at any stage in life really, but of course in retirement as well, is investments and income that is from an ISA, because any growth of your investments or the growth in value of an ISA is free from any kind of tax. And any withdrawals that you choose to make or income that's generated and paid to you is completely free of tax as well, regardless of your tax status. So that's something that's really important, and of course a very efficient way to generate an income for yourself. Now, how can Hargreaves Lansdown help? We've tried to talk about some of the ways in which you can invest through Hargreaves Lansdown. And essentially through the platform, you've got access to different types of savings accounts all in one place. So through the platform, first of all, we can look at having an ISA and a fund and share account. So ISA being that very tax efficient savings account, a fund and share account being that kind of general investment account we've talked about. Yes, you can hold investments in there, but they would be subject to taxes potentially. Then we've got a SIPP with HL. So self-invested personal pension. The advantage of a pension is that you can make very tax efficient contributions to it. You can then get up to 25% of it tax-free when you access it. And then you can move into things like drawdown or look at purchasing an annuity and so on. So that's something, again, you can have side by side to an ISA and a fund and share account. Thirdly, we've mentioned our advisory service, and I'll mention a contact for that in the next slide. This is important because, as we mentioned towards the start of the presentation, people may well be comfortable doing and making these decisions on a non-advised basis and through their own experience, and they may have the knowledge and know-how themselves. But managing someone's money can be difficult, can be complex, and if you're not necessarily comfortable with that, you may feel that you might want to take additional advice for additional fees ultimately, but so you have the peace of mind that you've got the recommendation and the advice of an expert. So that's something that we can provide. It's not something you have to go elsewhere necessarily for. And then finally, active savings. So we talked about building up that cash buffer, those emergency funds or emergency reserves. Active savings allows you to, at the same time, hopefully get access to a competitive interest rate. But that's available all under one online portal, essentially trying to make it as easy as possible for you to manage those investments, especially if you're doing it on behalf of someone else as well. In terms of getting in contact, any questions from the webinar, please feel free to get in contact with me. Underneath my details there is that of Andrew Mentz. So I touched on the ability to take advice, or at least explore that and have conversations with people initially to see whether or not it's something that you want to take further. Now, the importance of someone like Andrew in this case is that he's not just an advisor at Hargreaves Lansdown, but he's also a member of SOLA, which is the Society of Later Life Advice. So specifically has the qualifications and the expertise in what is a very difficult or complex area to try and make sure that you ultimately would get provided with the best service possible. So someone with experience in dealing with these kind of issues that we've talked about in the presentation. In terms of getting in contact, we've got our help desk number there, we've got the advisory section of the website, the general HL website as well, with lots of the information about the investments that we've talked about, as well as an email and an HL app as well. So you've got it covered when it comes to getting in contact with us and making sure your questions are answered. That sort of draws everything to a close. So thanks very much for listening. If you could kindly cast your eyes over our important investment notes. It's basically to reiterate that I'm not here to give advice. Investments can fall as well as rise, and tax rules are subject to change as well. But thanks very much for listening. I hope you found it useful.